Welcome to the NFO review series. I'm Ren Agarwal. In this video, I'm going to be reviewing the Miraeasset S&P 500 Top 50 Fund NFO. Oof, another NFO, that too of an international index. And it's not that it's not there. I mean, you do have S&P 500, you have the NASDAQ, then you have the FANG stocks index. I mean, there's so many indices. How does one decide whether to go in for this fund or not? Let us first understand what is this fund all about. Well, it's going to be tracking the S&P 500 top 50 index. So it's the top 50 index and not the S&P 500 index. It is the top 50 stocks by free float market capitalization in the S&P 500. So what is this index all about? It basically contains the top 50 stocks in the US markets by market capitalization. So of course, it has huge amount of exposure in technology stocks like Apple, Alphabet, Microsoft, Facebook, Tesla, of course. In consumer, they have exposure in pharmaceuticals like, for example, Johnson & Johnson and Pfizer, Walmart, Cisco, and many other stocks like Salesforce and Nvidia. So a wide variety of stocks that actually come within this particular index. So essentially, these are all really big mega stocks that are available in this particular fund, and the top constituents make up more than 50% of the index. The index is rebalanced every June, and the expense ratio of the fund in the direct plan is 0.37%, and in the regular plan, it is 0.62%. Now, when we look at the performance of this particular index, of course, we find that it has low correlation to Nifty 50, but it does have a very high correlation to the S&P 500 index. And of course, the performance, when one looks on a rolling return basis, one finds the performance to be pretty similar to that of the S&P 500 itself. And of course, there have been some years where this index has done well, some years where the overall S&P 500 has actually done better. But certainly, from a diversification perspective, the correlation with Nifty is low, and hence it does provide a country diversification. So should you invest? That is really dependent upon what is your existing allocation to international investments, specifically to US stocks as well. So if you already have a very high exposure within your international diversification to US based equities, or you already are holding NASDAQ 100 or the S&P 500 or the FANG index, then this fund may not really help, because there is a 98% correlation to the S&P 500. The fund itself has about 38% of its portfolio into tech stocks, which you can easily find in the FANG and the NASDAQ index itself. So the first thing you really need to be asking yourself is, what is the exposure that you have to international investments, specifically to US equities? And if it's high, then you'll really have to think about it. Looking at the returns as well, as I mentioned earlier, there is not much difference between the returns of the S&P 500 and this particular index. And whatever divergence that you're seeing is only in the last 1.5 years. And that could also be because of the way the US markets moved once COVID started. Clearly, the tech stocks have rallied in a very, very big way. And that's what's probably helped cause this particular divergence. But otherwise, given the fact that there is a 98% correlation with S&P 500, I do not find the S&P 500 top 50 index as really complementing the S&P 500. It's pretty much, investing in a similar index itself. And it really remains to be seen whether this divergence on returns is going to continue for the long term. The index funds of late have also had another issue, that of a tracking difference. Now, what is the tracking difference? It is the difference between the performance of the fund and the performance of its benchmark. And if you were to look at some of the other S&P 500 funds that are there in India today, there is a fair bit of difference in performance between the index and the fund, roughly in the range of about 3 to 5%, which is actually quite a lot. And there is also a difference in the price between the ETF and the FOF as well. So remember, in the ETF, you're buying it through the exchange, it works out cheaper. The fund of fund basically invests in the ETF, but it's convenient for you because you can buy it basically through the fund house, and that makes it an easier transaction for you. But again, there is a price difference over there as well. So I do think that index funds are still evolving, and we haven't got to that level yet where costs are pretty standardized, and there's a tracking errors are also standardized to that particular extent. So my take, as I mentioned, you will have to look at the existing exposure that you already have internationally and within that in the US markets, and only if you want a very highly concentrated exposure do you actually go in for this particular fund, and that to a concentrated exposure in US markets. Again, I would say stay away. I would actually wait and watch on the tracking difference and on how the expense ratios really play out before investing into this fund. So I would say stay away from this particular fund. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye bye.